Hey, and welcome to Tax Tuesday. Welcome to 2025, actually. I am Heather Ryan, also known as the Tax Queen, and I own a firm called Tax Queen that supports RVers, digital nomads, business owners with their taxes, tax prep, tax strategy, tax savings. Um, I'm going to go ahead and jump in. So this is Tax Tuesday, the first Tuesday of each month. I take questions that most of the time I get in advance, but if you're here live, feel free to just drop in the chat where you're coming from, confirming that you can hear me and all is good in the tech world. If you do see me looking to the side, I do have the questions up on a different screen so that I can have all of it available. And so I'm going to dive in. I did get a few questions. Some of them are pretty good. I think they're good and they'll have some lengthy answers. So I'm going to just dive in. Again, if you're here live, feel free to drop questions in. I do take live questions once I've gone through all of the previously submitted questions. So feel free to dive in and jump in there. The first question is, I'm putting together receipts and costs for a property sale. We are not sure what costs and expenses will help us reduce the, the tax on both federal and state level. We also gave the buyer a $5,000 credit. Do we deduct this from the capital gains? So basically, when you're selling a property, this person is selling a property and they're asking what expenses come off, right, as part of the expense of sale. So that's what we're looking at. So we have our cost, right, the original cost that we paid for the property. We have the sale price, right? Whatever we sell it for. And then we have all the expenses in between, right? So that could be capital improvements. That's going to add to your cost or your basis. That's the term that's used in the tax world is basis, if you ever hear that. So if you put in a new HVAC system, if you did landscaping in the backyard, at $10,000, $20,000, those all add up to your costs and your basis. So they're increasing it. You also get to take anything that was an expense of sale. So that includes the commission, taxes, credits you gave the seller or the buyer. Sorry, you are the seller. So all of that will help reduce. And if we're talking real estate and it's something that you've depreciated over time, you actually do need to recapture that depreciation. So that's going to have a negative effect. But all of this together comes to get adds up, subtracts whatever it is to get what you're going to pay capital gains on, because this is clearly an investment property. This is not a personal residence. So I hope that kind of explains it a little bit better, gives a little bit better of an answer. But yeah, expenses, commission, a lawyer if you have to pay a lawyer. I know that there's like title insurance and all kinds of things out there can be state specific that are required by law. Anything like that. So, yeah, I hope that answers that question. Great question on real estate. And the next question. As a 1099 contract employee, what should I be tracking throughout the year and what deductions can I take? So let me make a correction here. A 1099 contract employee, this doesn't exist. So you are a 1099 worker. You are not an employee. An employee is a W-2 earner. That is an employee. A 1099 worker is a contractor, okay? And you own a business. It just means that you receive a 1099 to show your income. Maybe you only have one client, that one person that you're working with, that one company, but you are a business owner. You have a small business. You have a sole proprietor, most likely. And what do you have to track? You have to track all of your income, anything that you get paid throughout the year, and then any expense you have to do that work. So that can be software, that can be insurance, that can be anything really. Legal expenses, bookkeeping expenses, any kind of software, right? It depends on the industry. So just keep that in mind. I always stress having separate bank accounts when you own a business and tracking everything throughout the year. Don't take, okay, we're in January, right? So, oh crap, I have to get everything together because I was a 1099 worker. I earned my own money last year, and now I have to figure out all my expenses so I can reduce my taxes, right? It's January. Do you remember what happened last February? No. So that's why I stress using bookkeeping software, if you want to use a spreadsheet, that's okay, but make sure you keep it up to date. I suggest working on it weekly. At the minimum, you can do once a month and just tie everything to your bank account, right? To your bank statements, to your credit card statements. But again, I stress everything should be kept separate. So no personal expenses run through a business account, no personal charges go on if you have a credit card. Um, but really, that's how you're tracking everything. So keeping things separate. And remember, a 1099 worker is a business owner, not an employee. So just to clarify, I hear that term a lot. You are not a contract employee. You are a business owner and a contract worker. Employee. So let me actually get into a little bit of the difference there as well. An employee, so a W-2 wage earner, which is many of us, if not all of us, have probably at some point in our lives been a W-2 wage earner. And that means that that company gets to dictate your hours, the days you work. They give you the software and the tools needed to do the work, right? So that could be a computer, that could be a drill or a hammer if you're, a contractor, right? So like some kind of plumber, electrician or something. So if they're giving you the tools, dictating when you work, how you do the work, that means you're an employee. A contractor, on the other hand, so a 1099 worker or a small business owner, if you're working with the company, providing them services, you can work when you want to work. So whether that's at midnight or 10 a.m., it shouldn't matter. You provide your own software, your own tool, so your own computer, if that's what you're doing. Maybe you're doing design work, right? So you're going to provide your own software, your own computer to do that work, and you're going to work on your time. That doesn't mean that you can't have scheduled meetings to meet with your client. I mean, that's normal in the course of business, but in general, they can't dictate how you do the work. And that's really the biggest difference between a 1099 worker, a small business owner who's contracting for a company, and a W-2 wage earner. And that is how the IRS and the states define it. So if a company is dictating your hours, providing you tools to do the work, telling you how to do the work, you are a W-2 worker. And this gets misclassified and it can get you into trouble, actually gets the company into trouble. All right, maybe I went a little too into that question, but I really like to be clear on that because I hear that often, right? Next question. Is a bank or credit card statement good enough for expensing things like business travel or meals as long as it says the restaurant name? So no, absolutely not. This kind of piggybacks on my last question, right? So when you work for yourself, you have a small business, you're a 1099 worker or a contractor, whatever terms you want to use, um, you have to keep track of all your receipts. And a credit card statement or a bank statement is not a receipt. You need actual receipts. So if you go to a restaurant, you make sure that you get a printed receipt. I personally like to take a picture of it, right? We all carry our phones around with us. So take a picture of it immediately, put it into your QuickBooks or other bookkeeping software, put it into Dropbox, put it into Google Drive, keep a folder on your phone, like whatever, whether you have an Apple phone or an Android, using their phone, their camera, and photo organization, keep a folder there, that's fine, but keep a digital copy. And that way, you have it. That print copy can go away, right? I don't like having paper around. I understand we travel and all that stuff when we're trying to get small and not have extra stuff. So I recommend having digital copies of all your receipts. Nowadays, when we order things online, especially, it's really easy because the receipts come into our email. But again, make sure that that's kept organized so you can always find them. But a bank statement or a credit card statement does not serve as a receipt. You need an actual receipt, especially for meals. Yeah. Meals, buying a computer, I mean, it doesn't matter. If you go to Walmart to buy some ink for your printer, all the receipts should be saved. So hopefully that answers that question. All right, next question. Again, if you're here live, feel free to drop questions in the chat. I'm happy to answer some. I only have a couple more questions to go. If I don't get any more, then I just sign off. So this question is, I'm currently living 6 months in New Mexico and 6 months in Texas. In New Mexico, I support my mom. Um, okay, that's fine. I'm gonna kind of make this a little briefer. I work as a contractor, and beginning in April, I received 1099 income. So we're kind of on a theme on this one with 1099 income, self-employment. That's great. I like it. So I want to start a business in 25, selling jewelry and wearables. And as a nomad solopreneur, I'm curious where I should start that business. So the simplest answer to this question is, first of all, what's your domicile or residency state? Who issues your driver's license? Um, like where do you file? What address do you use to file a tax return, to get mail, all that good stuff, right? That's our residency. Many of us as nomads call it a domicile, right? Because those are our ties to one specific state. So if Texas is that state, many people use that. There's great mail services there, and Texas is that state. Then register your business wherever your domicile or your residency is. That's my suggestion. So I don't care if you told me this was Wyoming and Ohio, it doesn't matter, right? It's where is your residency? These two states obviously border each other, so it makes it a little easier to travel between them. But yeah, where's your residency? My suggestion is always to open a business in the state of your domicile or residence state. There are exceptions to that, but if you're a solopreneur and you really want to have a registered business with the state, that's my suggestion. You can also, just so you know, operate as a solopreneur with just your legal name. You don't have to actually register anything if you don't want. So, for example, I can operate my business just as Heather Ryan. As long as it has my legal name in there, I'm allowed to use that. Many states also allow you to do a DBA, so a doing business as, fictitious name, some of the states will call it. So you can register that. So if I didn't want to legally register like an LLC or something with my state, I can operate as Heather Ryan, and then I can file a DBA as doing business as tax queen. And that's perfectly okay. That's legal. So again, depending on the state, but it should be in your domicile, in your resident state. That answers that question. Due to an extended illness, I have not filed a return or requested an extension. How long do I have to file my return and get a refund? And what if I owe taxes? Okay, so this is, let's say the first question is, if you get a refund, right? If so, you have 3 years from the original filing date to file your tax return to collect your refund. So it doesn't matter whether you file an extension, it doesn't matter. You have 3 years. So that's pretty awesome. So that's okay. If you were sick, if you had extenuating circumstances, you got 3 years, file that return, get your refund. Second part to the question, if you owe taxes, taxes are always due on that April deadline. I don't care if you file an extension, it doesn't make a difference. Taxes are always due April 15th or thereabouts, right? If that's a weekend, maybe it's the 17th, whatever it is, April 15th of that tax year. So if you think you're going to owe taxes, I always recommend making a payment for that deadline that stops interest and penalties. Immediately stops them. That's my biggest thing. And that's, I think, the biggest hiccup I see when people say I'm going to file an extension and they think that that extension grants them time to pay. And the extension is only for time to file. So remember that if you owe taxes, it's always due by April 15th. Again, if it falls on the weekend, right? We all know that it adjusts a day or two. And as far as avoiding penalties and interest, if you do have extenuating circumstances, this person, extended illness, there are provisions that could possibly get you out of penalties and interest. It just depends, how bad they are, and if you can prove, the circumstances. So my suggestion is always to file a return as soon as you can. If you have an illness, if you have extenuating circumstances, whenever you come out and get that breath of fresh air and you're able to file that return, do it as soon as you can. Don't wait. Don't delay even further, because interest and penalties do accrue monthly, from April 15th. So there is also a failure to file penalty. So you're not only getting interest and penalties on the tax due, but on the failure to file your return. So that's why I say stop that, stop all penalties and interest, file that return, and then work on getting the abatement for penalties and interest. So that's all the questions that I got ahead of time. I do see a question on here live. Thank you for joining here today. And I'm gonna, let's see, if I pay up front for travel and then get reimbursement by the company, can I write off that amount? So you would count that as income. This is how this works. So if the company, like you travel to a company and they pay for that flight, or they pay for you to stay in a hotel, and right, they're sending you money, that's still money that you're getting paid, and then you get to take the deduction. So it's going to balance itself out. I hope that makes sense. So if they paid you $1,000 to travel to visit them, then you get to take the $1,000 deduction. If that's what it costs. I'm just throwing a number out there. Yeah. And let's see, I'm getting good questions here. I like all this in person here, interaction. So we have a mobile RV business and we have no sales in Maryland and Florida. We have had sales, sorry, read it wrong. In Maryland and Florida. Tennessee is the state of residency, and we paid an estate sales tax. I'm not reading that. Do we have to file state income tax in Maryland? Do we have to try matching expenses to Maryland sales? So in general, just this to answer this, I work actually with a lot of mobile businesses and particularly a lot of mobile techs. And you have to hit certain thresholds usually to file an O income tax in a certain state. So if you told me that you were in Maryland for like the whole summer for 6 months, you're probably hitting those thresholds if your business is doing well. If you were there for a month or less, and what I don't know off the top of my head for this specific, Maryland, um, but yeah, they all have their own income thresholds. So it really depends on the state, and you just have to look that up. And you would want to make sure to match all of your income and your sales along with the expenses that go with them. So you can actually sometimes just do a percent. Sometimes people do that. If 25% of your sales were in Maryland, then pinches are about 25 your expenses, right? So we can kind of match that up. But generally, I like to see people that are traveling like that to matching their sales and what state it's taking place and expenses while you were in that state. But again, every state has its own threshold for needing to file and pay taxes in that state taxes. I rented out an RV under an LLC after 4 years. I exited the business but kept the RV for personal use. I'm looking to sell it in 25. What should I expect? So, in terms of depreciation recapture, that's a great question. Um, you're going to have to put that as ordinary income. Depreciation recapture. So when you take depreciation on a rental property, or in this case, an asset, a business asset, then you have to take the depreciation that you took as that deduction, you recapture it as income the year you sell the asset. In this case, it happens to be an RV. So whatever, I can't answer, what that number is, but whatever it is that you took to depreciate it. So if you took $25,000 of depreciation, you recapture $25,000 and it's ordinary income. That's a tax stat. So yeah, that's the way the IRS sees it is you get the benefit, right, when you're running the business, but if you stop running the business, now you don't have that anymore. It's also factored in of how much you get for the sale of the RV. So it's kind of like the real estate question. Um, and RVs generally do depreciate in value, right, over time. So you can also look at it that too, if there's a loss there or something. So I can't answer the specifics unless I see numbers. And I do work with, my clients on stuff like that. So. If there's not any other questions, this has been a great session. I appreciate the live questions. And if anyone has anything for the future, sorry, I'm just grabbing the link. This is questions. This is the link to submit questions in the future. So the next date for Tax Tuesday will be February 4th. Again, the first Tuesday of every month. And I really appreciate you all being here. And I hope you have a great 25 and a great January. And I will see you next time. Thanks a lot.